You heard what Robert Kaplan just said. Do you share that concern about the national debt as we go forward?
Sure. Well, first of all, thanks for having me. I do. I agree with Rob. Over the long term, we absolutely need to get our fiscal house in order. And if it were up to me, it's up to Congress and the White House to design tax reform. If it's up to me, I would prefer something revenue neutral. But it's not a short-term issue. It is a long-term issue.
President Kashkari, this leads to consumer debt because we've seen consumer debt rise substantially in this low interest rate era, not necessarily with mortgages, but certainly with auto loans and credit card debt and student loans. And if you look at a graph of Fed data showing consumer credit outstanding has reached the highest on record if you strip out mortgages. That's what we're looking at, especially as short-term rates rise. How concerned are you about this? And is holding rates low for longer only going to exacerbate it?
Well, we look at a lot of different metrics and trying to look for signs of financial instability. Is leverage growing in the economy, whether it's mortgages or the sectors that you talked about? We're not seeing a huge buildup in debt overall looking at the economy as a financial stability issue. Obviously, for individuals, it can be challenging, whether it's student loans or credit cards or autos that you mentioned. But we keep coming back to our dual mandate goals. Congress has assigned us a goal of stable prices. We define that as 2% inflation and maximum employment, as many people who want to work are able to find jobs. We continue to come up short in our inflation mandate. Inflation has been falling this year, not rising, and there still seems to be slack in the labor market because wage growth is not taking off. And so for those reasons, I think that we need to focus on our dual mandate goals and keep interest rates where they are and allow that inflationary pressure to come to us instead of getting ahead of it the way we are right now.
President Kaplan suggested we have a long-term problem, but with the debt we have now and the tax cuts coming, adding to that, do you believe in the crowding out theory? Are we going to see interest rates rise because there's not enough national savings to meet all of the spending and tax cut promises that Washington's making?
Well, eventually that has to be true. I mean, eventually we do have to pay our bills, but that could be over many, many years. And over the near term, I don't see a problem. If you look at the bond market, we've been raising interest rates. Congress has announced that they haven't quite enacted it yet, but they're about to enact the tax cut. And the long end of the bond market is not moving. The 10-year really is not moving in response to that. And so right now, it seems like disinflationary pressures are a bigger concern than inflationary pressures. But over the long term, that has to be true. There has to be a crowding out effect because eventually we do have to pay for the bills that we have come due.
Well, is the bond market telling the president he's wrong about the potential for increasing the growth rate of the United States?
Well, I think the bond market is saying that a couple things to me. One is inflation expectations are drifting lower, or they have drifted lower, and that's in large part, I believe, because of the Fed, because we've been sending these hawkish signals by raising interest rates in a low inflation environment. And second, I think the markets are also pricing in a lower neutral real interest rate. So the interest rate that balances savings and investment in the economy is set by broader macroeconomic forces. It's been trending down over the last few decades. I think markets are embracing that concept and pricing in a lower, we call it R star, which then caps where bond yields are, and at the same time can explain some of the appreciation in the equity markets as they're discounting cash flows at a lower rate. And so those are the signals that I take away from the bond market right now.
So, Neel, I really want to specifically go into the long end of the yield curve. I'll put up a number here. It's the 210 yield curve and how it's come down. We understand why the short end is coming up, given what the Fed has been saying. Talking about the long end, if you had your way, if you went from what the Fed is predicting now, 3 increases next year, to 1 or maybe no, what would happen to the long end of the yield curve in your view?
In my view, I think that would take off some of the downward, the disinflationary pressure that I think the committee is putting on the long end of the curve. Because in my view, by raising interest rates in a low inflation environment, we are sending a signal that our 2% inflation target is not a target. We're sending a signal that it's a ceiling, that we're not going to allow inflation to creep above 2%. And I think that's putting pressure on the long end of the curve. If you look at the way we've behaved, not at what we've said, we say it's a target, not a ceiling. If you look at how we've behaved over the last 5 or 6 years, we've been treating 2% as a ceiling. I think markets have figured that out, and they're pricing that in. So to me, the Fed is pushing up the front end with our rate increases and pushing down the long end by sending this very hawkish signal about the outlook for inflation.
So if it wasn't sending out a hawkish signal, I'm not going to try to pin you down an exact number, but give us some directional guidance here on a 10-year Treasury. If it's now at 2.4, give or take, Where would it be? Is it 3? Is it north of 3 if you backed off on the signals being sent by the Fed?
Well, I mean, I think it's normal to expect some flattening when the Fed is in a tightening cycle. You see the front end tends to move up more than the long end does. But I do think it would be higher than it is. And I don't think that I would have expected with the tax reform package coming together, I would have expected some movement in the long end. But the fact that the long end is not moving in response to either our hikes or the tax package, that tells me that inflation expectations must be solidly anchored and or drifting lower. And so that's what's concerning to me. And if we continue down this path of pushing up the front end, I think we're going to see a stronger flattening take place. And that's a concerning sign.
Just based on the economic situation that we have right now, how many rate hikes do you think we should have next year?
Well, I don't like to forecast because I think that just adds to noise when you have all the presidents out there giving their own individual forecasts. I have said that I think we should allow core PCE, core inflation, to actually move back towards our 2% target, and then at that point evaluate whether or not we should continue raising rates. We've been surprised. When I first dissented in March, I didn't predict falling inflation. I simply said I don't see much evidence that inflation is climbing. Since then, inflation has actually fallen and wage growth has not accelerated. I would like to see more evidence that we are actually moving back towards our target before we commence with further rate increases.
Tax bill's going to pass. What are CEOs in your district telling you they're going to do with the extra cash they have? Are they going to invest it? Are they going to give it back to shareholders?
I think very few CEOs that I've talked to in my district say that the tax package is going to lead to some dramatic change in their behavior. I think they're happy to have lower taxes. And if you look at the behavior of firms over the last several years, it has been more about buybacks and dividends than it has been about increasing investment. Certainly the large firms that have big cash piles abroad, they can borrow exceptionally cheaply in the U.S. today. And so the idea that this cash that's sitting abroad is what's holding back investment in America today, I just don't think that that's credible. I do think it's going to lead to more buybacks and more dividends. That's not necessarily a bad thing, but I don't think that itself is going to lead to a dramatic increase in investment or hiring in the U.S.
You've been talking about the need to absorb labor market slack, get more people into employment. You led a campaign to work on bank regulation and talking about income inequality these days. You sound very populist, and I'm just wondering, you ran for governor of California. Do you want to go back into politics?
No. I mean, I'm very happy at the Fed. I ran for governor of California the same reason I joined the Fed. I cared deeply about public policy and economic policy. And one of the things I love about the Fed is we have a nonpartisan public policy mission. I simply want us to take on the biggest economic issues that we face as a region or the country and make as big a contribution as we can. And whether that's trying to get monetary policy right, make sure that taxpayers are protected from too big to fail risks, or trying to create an economy where everybody gets to participate, I think those are all enormously important issues, and I'm proud that we are trying to make a contribution on them.
Two of your predecessors at the Minneapolis Fed, Volcker and Corrigan, went on to become the president of the New York Fed, a job that's open. Are you interested?
No, I'm very happy in Minneapolis. I think Minneapolis is a wonderful community. My wife and I love living here, and I couldn't imagine going anywhere else.
Neel, finally, I want to turn to one of the more vexing problems in the country today. I think most people agree, and that is the growing disparity in income. And I'll put up a chart here, actually, that compares median to mean, which is one way of illustrating the extent to which that disparity has been growing. You have said that monetary policy might actually play an important role in this. Explain how that is, because most of us don't think of monetary policy as addressing this.
I agree. Yeah, that's conventional wisdom. When I travel around my district, and I know my fellow presidents hear this in their districts, it's amazing what a strong economy and a tightening labor market is doing. It's forcing businesses to work really hard to find workers. So you hear anecdotes of businesses that are giving ex-convicts a chance who normally would not have had a chance, or they're busing in workers to overcome housing issues, or they're saying, you know what, we're going to go train these workers to give them the skills that they need to do our jobs. The tight labor market is sending a price signal all across the economy that's motivating millions of private sector actors to do these extraordinary things to try to bring people back into the labor force. What I'm realizing is that's more powerful than any fiscal policy program that I've seen in terms of worker retraining or trade adjustment assistance. It turns out that this tight labor market of a strong economy and the appropriate monetary policy is having this dramatic effect. And so I just think that we need to recognize that allowing the economy to continue to grow. Don't tap the brakes before wages start to rise. I think it has profound benefits to workers and communities all across our country.